This is part 1 for time value of money. And first we're going to look at the present value of annuity, and present value of annuity due. And we'll work through some examples and explain how that works and how we use the tables. Now the concept time value of money means money can be invested today to earn interest and grow to a larger dollar amount in the future. This is useful when you're trying to value a variety of assets and liabilities or options. You always want to make sure that you're comparing things in the same dollars, because a dollar today is worth more than a dollar in the future. Now, we have two kinds of interest. We have simple interest. So, simple interest is you would just take your initial investment times the rate times the period of time, and you would get interest earned. So an example is if you had $100 that you invested for 3 years at 5% simple interest, at the end of the period you'd have $15. Compound interest includes interest not only on the initial investment but also on the accumulated interest earned in previous periods. So for our same example, year 1 we'd earn $5. Year 2 we would earn more because now we would have that additional $5, so we'd get $5.25. In year 3 we would take the $5 we earned in year 1, the $5.25 from year 2, added to the $100 to give us $110.25, and we take that times the 5% interest, and as you can see, what's going to end up happening is we're going to end up with $15.76, which is more money. So you always want to make sure your interest is compounded. Now, there are 6 value tables. We focus primarily on the present value ones because we're trying to look at potential purchases or sales based on current dollars, and that means we have to use present value tables. So we have the present value of a single sum used to determine the current value of a single sum that will be received sometime in the future. Example, you owe $1,000 in 3 years at 10%. What's that worth in today's dollars? Present value, use of an ordinary annuity, used to determine the current value of multiple payments of the same amount. Now remember, you can only use these annuity tables if the amount is the same every period. So, in this case, we would assume that the payment is at the end of the first period. That's when you use this table. Now, if the payment is up front, right when you sign the contract, you have to use the present value of an annuity due. Again, it's the current value of multiple payments of the same amount received in the future, with cash flow starting at the beginning of the period. Now we also have these 3 tables that we use for future value, and in these what we're going to do is we're going to look at what is something worth in the future. If we have an amount today, in this example, if we were to receive an amount in 3 years of $1,000 at 10%, how much money would we have at the end of that period? What if we were to make payments with the first payment, same payment each time, first payment at the end of the first period, or the first payment at the beginning of the first period? So we have a total of 6, but we primarily focus on the first 3. So now let's take a look at an example. My company is in the process of purchasing several large pieces of equipment from Danny Machine Company. Several financing alternatives have been offered by Danny. They can either pay $1 million in cash up front. They can pay $420,000 immediately and the remainder in 10 annual installments of $80,000, with the first installment due in a year. And the third is that they're going to make 10 annual installments of $135,000 with the first payment due immediately. And then the last option is make one lump sum payment of $1.5 million 5 years from the date of the purchase. So what we're going to do is, if we assume that they can borrow the funds at 8%, how do we turn all of these into today's dollars. Now we know first option is in today's dollars. Option 2, the $420,000 is in today's dollars, but the $80,000 is not. So we'll start with our second option. Pay $420,000 immediately and the remainder in 10 annual installments of $80,000 with the first installment due in 1 year. So it looks to me like, based on that, we know that the $420,000 is the value, but now what we need to do is we have to convert the 10 annual payments of $80,000, and we need to use the present value of an annuity because it's made at the end of each period. And we know the interest is 8%. Now, since there are multiple payments of the same amount over time and the payments are at the end of each period, again, we're going to use the present value of an ordinary annuity table for the factor. Now, this is the table, and the first thing we do is we go down the side to find the number of years. And in our case, it was 10 years. Then we're going to go across, and we know it's 8%, so we're going to go to the column that says 8% and find the factor. And that's the factor we're going to use, and we're going to take the $80,000 times that factor. So, how do we do that? We're going to take our initial payment, and we're going to take the present value factor times the $80,000 to turn it into today's dollars. And that tells us that the net present value of all the payments are $956,806. So that would be the net present value of option 2. Now we're going to go to option 3. Now in this case, we are going to make 10 annual payments of $135,000. The first payment is due immediately. And we have 10 periods, and the interest is still 8%. So, since the first payment is due immediately and we have multiple payments of the same amount, we use the present value of an annuity due. Remember the difference between the two tables. So, we go to the table, we go down to 10 years, and then we go across based on 8%. This is the factor we're going to use. Right here, 7.24689. So we're going to take the $135,000 times the factor, and our option 3, the present value, is $978,330. Now we have option 4, one lump sum. So we're going to get one payment at the end of 5 years. The number of periods is 5 years. Our interest is still 8%. So now what we're going to do is go to the present value because we want to know what $1.5 million is worth today. So we're going to take out the interest. And our factor will be 0.68058. Now we're going to multiply our 1.5 million times that factor. And we end up with $1,020,870. So our best option actually would be option 2 because it is the lowest in today's dollars. And that is the end of our presentation.